Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks. I don't think people are paying enough attention to the big cycle.
Ray Dalio was back on CNBC last week and is warning investors that there could be significantly more pain in the stock market in 2023. In fact, Dalio expects stocks as a group to perform so poorly that he believes cash currently offers a better relative return. In the exclusive interview, Dalio gave his best explanation yet of the long-term debt cycle and how it affects us as we participate in the economy, and how it helps to explain what the economic environment may look like over the next few years. Ray Dalio is one of the most successful investors of all time, with a net worth of $19 billion, primarily built through founding Bridgewater Associates, currently the biggest hedge fund in the world. Ray Dalio is one of the few people I turn to learn about the economic machine, because he does a terrific job at breaking down the complexities of the finance world into a few key building blocks, forces, factors that ultimately influence what we see and what happens. The economic machine has three key components: a productivity curve, a short-term debt cycle, and a long-term debt cycle. An economy is simply an aggregate of many individual transactions between people, businesses, and governments. Transactions where money is being exchanged for goods, services, and financial assets such as stocks. Productivity is the simplest part to understand. Over time, humans get better at making products and services through an accumulation of knowledge, which ultimately raises our living standard, and Dalio calls this the productivity curve. For example, the knowledge we now have about creating motor vehicles has caused a dramatic increase in efficiency of supply chains, which has reduced the cost of goods and services and improved our living standards. Over the long run, productivity drives economic growth, but in the short term, it's debt that drives the swings we see in the economy. And that's because debt essentially allows us to consume more than we produce when we acquire more debt, and forces us to consume less than we produce when we have to pay it back. In the case of the short-term debt cycle, it typically takes place over a 5 to 8 year period. The increased use of debt drives higher spending, and when spending exceeds production, we get higher prices, or ultimately what we call inflation. This is where the central bank steps in to raise interest rates to slow down inflation. Those higher interest rates increase the cost of debt, forcing people to spend more on their debt financing rather than spending elsewhere in the economy. Less money spending causes prices to decline and leads to a recession. And if inflation is no longer an issue, then the central bank will lower interest rates, starting the short-term debt cycle all over again. There have been 12.5 short-term debt cycles since 1945, with the last full cycle beginning in 2008, when the Federal Reserve lowered interest rates to 0% during the global financial crisis. And that cycle ended in 2020, when the pandemic recession once again forced interest rates to 0%. But not only are we currently in the middle of a short-term debt cycle, we're also right at the beginning of the long-term debt cycle, which typically takes place over 75 to 100 years.
There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. And then there are issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money.
The beginning and end of these debt cycles that take place over multiple decades is something that has severe consequences for investors, and it's also something that no one alive today, or very few people who are alive today, would have experienced before. While the amount of debt increases and decreases in short-term cycles, it also tends to accrue over multiple cycles. In his latest memo, Dalio said, "Debt liabilities and debt assets have virtually always increased to make the long-term debt cycle expansion. In all cases, this has continued until the debt burden has become unsustainably large, or the debt assets have become intolerably low returning, at which time there are big reductions in debt liabilities and debt assets that take place through a mix of debt restructurings and debt monetization. These are the big debt crisis periods." The best way to understand what Dalio means by these long-term cycles is to simply walk through the long-term cycle that has just taken place, that began in 1945 and has recently ended. The long-term debt cycle has 4 phases. First phase began in 1945, when World War II ended and the US secured its position as not only the strongest economic force, but also the strongest military power, ultimately giving them control of both money and geopolitics. From 1945 to 1971, the US dollar was also backed and tied to gold, which meant that you could essentially exchange your dollars, if you wanted to, for gold, at the Federal Reserve. There were 5 short-term debt cycles during this period, which were categorized by the US overspending and funding that overspending by using more and more debt. Eventually, some countries that held a lot of US dollars realized that the US had way more claims on gold than actual gold to exchange for the US dollars, and they started to exchange their US dollars for gold. And this caused essentially a bank run on the US. But since the US didn't hold enough gold to exchange for those dollars, the US essentially decided to just sever the tie between the US dollar and gold, and today's fiat currency was created. As you might expect, this caused a dramatic devaluing in the currency. From 1971 to 2008, the US dollar was devalued severely, and during this period, there were also 5 short-term debt cycles, each with interest rates ending lower than the last, providing a huge tailwind for asset prices. In 2008, the global financial crisis caused interest rates to hit 0%, meaning the maximum effect of lowering interest rates had been reached, and a new type of monetary policy by the central bank would be needed to stimulate the economy. This marked the last phase of the long-term debt cycle, which is where there is rapid debt monetization, which in 2008 came in the form of quantitative easing. The Federal Reserve turned on its money printer and started buying a lot of government bonds. And this also continued in 2020 when the government needed even more money to fund its COVID stimulus checks. So again, the Federal Reserve printed trillions of dollars and bought government bonds. And what came next should have been little surprise to anyone. A huge amount of inflation came from all of this additional spending. And that brings us to the last couple of years, which I'm sure most of us are pretty familiar with what's been happening. To get inflation under control, the Federal Reserve has been increasing interest rates since mid-2022. And as a result of the increased interest rates, speculative stocks have collapsed and even the broader market has done pretty poorly. So where are we today and going forward, and which asset classes does Dalio believe will do best in the future?